Welcome to this week's strategy session. Thanks for joining me. Great having you with me for another show. And don't we have a lot to talk about today? Plenty of movements in the stocks, in the commodities, a lot going on. And also any stock codes you want me to have a look at later on in the show, we will do that as well. So have those stock codes ready. Let's look at the chart situation for whatever you're looking at. Now, as always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's get straight into our charts. So we'll begin with the ASX 200. And another rally this week for the ASX 200. And at 1 p.m. on Friday, the market is on track for making it 4 up weeks in a row. So from the lows up to where we are at this current point, 4 up weeks in a row. So that's another sign that the worst may well have passed. But prices have just hit a key technical level, and that sparked a pullback on Thursday. I'll show you what that means in a moment and what it could mean moving forward. I'll also cover the S&P 500 after we go through and do the ASX 200. And there's a fascinating indicator that I want to show you with the S&P 500. It's at a level that's never been seen before. So you need to see that for yourself. I think it's really interesting. But before we do that, let's start with this latest price action for the ASX 200. So the latest rally takes prices back above the 50 and the 100-day moving averages. And this is the first time the ASX 200 has been above both of these moving averages since back in mid-February. The moving averages, you can see the moving averages are also starting to round upwards and turn higher. And it'll still take a bit more time and probably a bit more upside before the moving averages actually cross. But it's a tentative positive. The ball is now starting to move back into the bull's half of the field, with prices now being above those turning moving averages. So why is it tentative? Why is it tentative and not just straight out bullish? Well, I'll show you why. Now, let me just compress this a little bit. We're going to just skip back to 2022 for a moment. And so what we had in 2022, you can see here's an important low point from that period. Market had a strong rally, got back above the moving averages. You can see the moving averages started to turn higher, but they never crossed. You can see the moving averages never actually cross. Then prices stalled and then started to come off and ultimately retested and broke below the lows. So that may not happen this time. I'm not suggesting that that's what's going to happen at all. I think the odds favour that we've seen a panic low, and coming back to today's price action, I think the odds favour we've seen a panic low and a V-shaped recovery. I think the V-shaped recovery is a sign that buyers are actively stepping in. But just being aware of the risk that just because prices get above moving averages, it doesn't mean, well, that's it, it's all now up and away. Moving averages are not magic markers. Rather, they're a guide to help us identify when conditions are in our favour and when they're not. Something else I think to be aware of is also what's going on with the 200-day moving average at the moment. So I'm just going to take off. So this is the 50 and the 100-day. Let me just take those off so we don't have too many lines on the chart at once. And I'll go down to the indicators and I'm going to put on, where is it? A simple moving average, which is a 200-day, a simple 200-day moving average. And now we've talked about the significance, and this is it here, this blue line. We've talked about the significance of the 200-day moving average a few weeks back. And we noted that when the market has an excursion below the moving average, which lasts more than a week or two, it's that often leads to a longer corrective period, and that's of course what ensued in this most recent case. Once the market had been below these averages for a couple of weeks, that risk did increase, and we saw that play out. But what happens on the way back up? Should we be watching the 200-day moving average? And I think the answer is yes. I think it's very much worth watching, and this is really where the market is right now. If the market is if the market is below the 200-day moving average for more than, say, a month, I think the 200-day moving average does become a key resistance point. And I'll show you what I mean. So we are getting through this a little bit today, but today hasn't closed and it's just a touch through it at the moment. So I think this is all still worth being aware of. So just coming back here for instance, back in 23, see the market rallied up to the 200-day moving average, and then there was a brief pause, a brief pullback before then rallying and getting through the average. And another period of note, and you can go through doing this for a lot of periods. I'm just looking at just a couple of recent ones. This one here back in 2022, market rallied into the 200-day moving average. Again, there's a pause, a pullback, took a little bit longer this time. Then the market got through and started to rally. But then there are other cases where it doesn't work like that, where the market rallies into the 200-day moving average and pauses and then turns down. So I think it's a key area to keep an eye on. One more period I'll quickly show you. It was after the recovery from the COVID lows. You can see this strong rally back to the 200-day moving average, and the market actually pauses for a couple of months just around that period. Actually, several months where it pauses around there before it breaks and starts to move higher. So the 200-day moving average, it isn't a perfect indicator and it doesn't pinpoint turning points, but I think it's an important reference level to be aware of. So coming back to the present day, where are we now? I think around this 200-day moving average, I think that puts the ASX 200 at a critical level. It's attempting to rally back through there on Friday today, and at the moment it is above there. As I said, I think the odds favour that the low is in a few weeks back and that the technical backdrop is improving. But the potential for a pullback around this 200-day moving average, it does still exist, just like we were going through with those some of those prior examples. Now, that doesn't mean be bearish by any stretch, just because the market has rallied back up to the 200-day moving average, thinking it's going to come down, because that may not happen. For me, it simply means I think we're still in a phase where it's about being conservative with risk. While the low may well be in, there could still be considerable volatility, especially while the market attempts to flip back onto the positive side of the moving averages, or that's being the 200 as well as the 50 and 100, which I'll put back on later on. So while we're trying to flip from the lower side of the averages to the upside, there's still the potential of that volatility coming in. I've added some risk through the week. I bought an equal weight ETF. I'll show you why I've done that. Let me just click over the equal weight. So this is the ASX 200 on an equal weight basis. I bought an equal weight ETF as prices were breaking above this resistance. You can see this resistance. We've talked about this. I think we talked about this last week. Big resistance area around 1,800. Prices started to break through there. So I bought an ASX 200 equal weight ETF. If you're interested, the ticker code is MVW. I think that's the only equal weight ETF that we have for the ASX. So you can check that out if you're interested. So I bought a bit of that as prices were breaking up. I've also bought some individual stocks. I'll tell you about one of those a little bit later. I bought some S&P 500 ETF, and I've also bought some Bitcoin. So it may sound like I've done a lot of buying, but I've still got plenty of cash on the sideline. It's really just, for me, it's been a case of shifting some cash back into risk assets, but I'm doing so in a conservative way. Coming back to the ASX 200, I don't think this is a time for aggressive risk taking. If volatility picks up again, and maybe it doesn't, maybe prices stabilize and then start to move higher in a more bullish tone with less volatility. That may happen. But if it doesn't, and if volatility does pick up, I don't want large P&L swings, and that's what you get when volatility really does. When markets are just swinging everywhere, you can get those large swings. I'm trying to keep my risk levels at more conservative levels. I think there'll be plenty of time for larger positions once prices establish themselves back above the moving averages. And I don't mean just being above for a week and saying, oh, back above the moving averages. I mean, sort of get above the averages, have a pullback, consolidate above the moving averages, and then start to move higher. That's when we get established above moving averages. And of course, volatility needs to settle down. I think now's the time for proceeding with, I'd call it cautious optimism. We're getting that strength coming through. Let's step into the market, I think, but also bearing in mind some of those risk factors that we've just discussed. Now, I'm going to jump over to the US market now. Of course, if you're getting some value from this, please hit that like button. Really important for me because it helps me a lot. And leave a short comment. Just, hey, thanks for the video. YouTube shows other people, which is, it's the key to being able to put these things together. That people watch them. So please do those things. Now let's go over to the S&P 500, and now you can see our moving averages are back to 50 and 100 days. So a lot has happened since last week when we did last week's strategy session, and prices have put on a bit over 4% during that period and rallied above resistance at around 5,500. You can see this blue shaded area, and we discussed that last week. So what was interesting was how the market traded on Wednesday after the GDP numbers came out in the US. So Wednesday is this bar just where you can see the cursor at the moment. So I'll just expand that a little bit more. What was interesting here was that you can see where the market opened. So there's the market's close from the previous day. The market opened lower, traded down to the lows, but then from there the buyers came in, pushed prices back up, and prices closed up near the high. So that was a pretty interesting day, given that also the GDP numbers were a little bit worse than expected. So when things are bearish, worse than expected numbers can really send things into a tailspin. But instead, the market, as we've said, it closed up on its high. So we now have a situation where we're seeing clear signs that the dips are being bought, and this is positive. It hasn't been a case of the rallies being sold, and so far at least, it's the buyers that are dominating. Wednesday's price action is also interesting. Actually, it's Thursday's. This is Thursday's price action. This next bar Thursday's is also interesting, and that is because you can see here. So prices have gapped higher. See, there's the close from Wednesday, gapped higher on the open, traded up to a high, then pulled back and closed near the low. So I initially looked at that and thought that doesn't look like the greatest price action where prices have traded up. Now they've closed on the low. So on the surface, that would be negative, and it's also happening near the moving averages. You can see the 50-day and the 50-day and the 100-day. 100 days on top of this point. And this is where the risk of selling increases. Markets move back to the moving averages, and then this is where selling can often occur during bearish phases. But let's zoom in. I want to zoom in on this single bar from Thursday, and this is what I did when I looked at the price action this morning. Let me just jump over to a 15-minute chart so we can actually break this bar down in a little bit more detail. So here it is here. This is a whole day's price action. You can see there's the gap higher. Prices trade up into the high and then they move down, they move sideways. There's a sharper move at the end, but generally it's most of the day is spent going sideways. And the sell-off that we had, it's not, except for this final 15-minute bar, which is just one bar, it's not aggressive selling. Rather, it looks more like a sideways consolidation, which suggests, once again, the dip being bought. We saw something similar last week, and I talked about it in last week's session. There was a gap higher, traded up to the high, closed near the low, but it was a corrective looking pullback. It looked like the dip was being bought. And sure enough, it was being bought and prices moved a new high. I look at this price action and wonder whether something similar could be happening here. And I think it's encouraging, and it gives the appearance of of this being a market that is in fact trying to rally. So let's jump back to a daily chart. I think this break above 5,500 opens further upside potential. I think it increases the odds that this sell-off was indeed a panic-induced event and not the start of a larger bearish period. Going over to one of the important indicators that we've been keeping an eye on, it's the percentage of S&P 500 stocks above the 100-day moving average. I won't explain how it all works now because I've done that in previous weeks. So what's happened here? We're seeing this after breaking below 10%, so less than 10% of stocks being above their 100-day moving average. We're seeing this percentage of stocks continue to increase. And just on Thursday, it's gotten up to about 35% of stocks being above their 100-day moving average. And this is a sign that the internal strength of the market continues to improve. What's also interesting is that when the percentage drops, so when this percentage drops below 10% and then rallies back above 10%, and then continues to move up, and we get to a kind of the point where we are now, say back towards 30%. So when you get that condition, let's just compress this and look back. When you do this, you can see the years down below. So there's 2021, 2018, and we scroll back. So look at these times. It's gone below 10 and then moved up, below 10 and then moved up through to about 35%. When this happens, there are no cases where there are no examples in the again here we go down to 10 and then starts to rally, 10 then starts to rally. Same back here in 2011, and it goes back to the start of the indicator around 2009, which is the bottom of the GFC. What you see is there are no examples where, at least none that I saw, where the market gets to as high as rebounds as far as it has from 10%, and then comes back and revisits 10%. Once it starts getting that momentum, there's a tendency for that momentum to start to build. Now, one case which I think is worth noting is over in 2015. Just shows how different types of price structures can emerge. So we've got this same thing in 2015. So the market's gone below 10. It's rallied up. It's now up through 35%, and you can see it continues to rally. Now, and then later on, it comes back and retests 10%. So let me just jump back over to an S&P 500 chart for a moment and show you that period. It will all make sense to you in a moment. A little bit further back, it's this period through here. So this is where the market initially gets down to 10%, then starts to rally back up towards 68%. So it's a significant rally, and it goes on for many weeks. But then you remember that the indicator came back and it retested 10%, and this is where the market actually pulls back and does make a new low. It's sometime later on. So while the indicator has, I think it's got an excellent record of identifying reversals. It's not always the final low. So there's nothing to say that we're not currently here. Maybe the market does rally further, but maybe it does peak. Maybe it's not all over. We can't deduce that from what we can see from the indicator at the moment, but it's it's just to say you always have to be wary that there's no guarantees with anything. What we currently have is a momentum shift that typically leads. We have this momentum shift, which typically leads to higher levels. That's what we're seeing playing out now. We're seeing this momentum shift that potentially leads to higher levels. But as I say, there's never a guarantee of anything. I think we should remain conservative in our actions that we take at this point. As I said earlier, I've added some S&P 500 exposure as prices have started to move up, and I'm happy to see where this momentum takes us. But until prices become established above rising moving averages, like was the case a year and 2 years ago, I'm holding that extra cash. I'm maintaining a reasonably defensive position. And there's still plenty of scope for, yes, it's been a good 4 weeks, but there's still plenty of scope for conditions to remain difficult. And don't overestimate or don't overlook the possibility that maybe prices do rally further before then coming back into a large trading range for much of the year. There's all sorts of ways this could play out. It's not simply a case of prices either making new highs or making new lows. They could also spend months. They could spend months just chopping sideways, making it difficult. So that's why I say I don't think it's a time to get aggressive. Despite there's some positive signs coming back in, but I think it's still worth being conservative, not aggressive. We still don't have a bullish structure. We have signs that a structure could be developing, but it's not a bullish structure. Above rising moving averages, bullish structure. Where we are now, be careful time. I saw a fascinating indicator through the week. Now this is from. Let me show you. This is from the analysts over at Sabu Trade, and I find it fascinating because it shows the number of consecutive weeks that more than 50% of the AAA survey participants, so that's the American Association of Individual Investors, so the number of weeks the participants of the survey have been at 50% bears or more. And you can see here is it's 9 weeks in a row. 9 weeks in a row that the survey participants have been 50% bearish or more. And it's a record for the survey. The survey goes back to the late 80s, and you can see the figure up here, and nothing else gets there. The closest was in 1990, where it got to about 7 weeks. So what does this tell us? What we can see from the past is that peak bearishness is something that tends to coincide with lows, not the start of big bearish tops. So if you look at this peak from I think that's 2023, coincides with the low. This is the peak from COVID, of course. Peak bearishness was at the low. This period from the GFC is interesting. We've got 2 spikes, one which was at the low, one which was near the low, and we have another one. The early one was a few months into the decline. Things got bearish, and then they started to recover from a bit, and they took a really, really bad turn. But still, it was still several months in, and then you got this one from the 90s, which was, of course, marked the low. At these big previous highs, generally you don't get many bears, and so a lot of bearishness, and we're not that far from all-time highs. Now this is from a week ago. This was published a week ago, and it's even though it's a week old, I had a look before we came on air, and the as of Wednesday, the last time the survey came out, the percentage of bears was at 59%. So it's at high levels. So yeah, this remains intact. Um, I think this is another sign that the low's in. It's not necessarily a sign that we're going into a big ongoing bullish phase right away, but I think it's a sign that we've seen peak bearishness. As I said, I'm conservatively moving back into the market, but as I keep saying, I don't think it's a time for aggressive or complacent buying. Risk remains elevated. S&P 500, it's still below. It's still below its 200-day moving average for the S&P 500. I haven't put it on, but that's still a couple of hundred points higher. It's trading around the 1,500-day moving averages, and I think we shouldn't underestimate the possibility that further volatility does come in. Maybe it rallies a bit, pulls back a bit. Even if the low's in, there can still be volatility, and that can still make it difficult. So, as I say, conservative with risk, but cautiously optimistic, moving some players back onto the field. Okay, so I'm going to move on to the US small caps now. Then we've got the local small caps, all the commodities, any stocks you want me to have a look at. We're going to do them in a moment. But of course, that wraps up the free section. If you're not a Strategy Session member, there's a link below. Click that, come on in. Hopefully you get lots of interesting information for the small amount of money it costs to be a part of the full strategy session. So, okay. So let's start off. Let's start off with the Russell 2000.